Back, Kingdom REI community, to part 3 of the Real Estate 101 investing series. And today we are talking about the holy grail of real estate investing, taxes. Listen, I think I've hacked the LinkedIn strategy. As we speak today, I made a post just a couple days ago or last week or whenever it was when Donald Trump's tax returns came out in the New York Times article. And I simply made a post about Donald Trump. It wasn't much of a shock that he's not paying any money in federal income taxes over the last decade or however long it's been, because he's leveraging commercial real estate and other things like his business to shelter his income from taxes. Not a big surprise. People have been doing this forever. And I, to date, have over 40 or approaching 40,000 views, over 400 reactions, and 200 comments. For sure, like 10x the best post I've ever put out on LinkedIn in terms of engagement. And, it hit me. Listen, and maybe you've experienced this as well. The reason I think this is getting so much traction, this post, is really the same dilemma that you've probably had around your Christmas table or Thanksgiving dinner table, or what you've even see today in the media, that people are up in arms. And there's this big divide around why the wealthy, even though they're meant to be taxed more, continue to pay less and less in federal taxes. And really, it's a lack of understanding of how the tax code is written and how and who it serves and why it serves them. And it's the reason why the wealthy continue to own assets and continue to own real estate, because of the massive benefits that real estate provides to shelter your income from taxes. And it's what I want to teach and show you today, because you actually don't have to be a billionaire in order to implement this strategy, that you too, no matter where you are in your investing journey, you can use and leverage real estate to keep more of your money in your pocket at the end of each year. Who wouldn't want to have that? Who wouldn't want to do that? And so, really simple, let me explain it this way. Owning real estate is very similar to owning a business, in that you have a profit and loss statement, right? You have income coming in and you have expenses going out. And so at the end of the year, your CPA is going to look at that and say, did you have a net profit or a net loss? And depending on that, determines on what you pay in taxes. The same thing is true in real estate, especially in large commercial real estate. When we buy real estate, we're buying a business. We're buying an income stream. And there's profit to that and there's losses to that or expenses to that. Distinctively, though, one of the losses that we get to count on real estate is something called depreciation. And this is not something you pay out of pocket, right? But it is a paper loss, because real estate depreciates over 27 and a half years. It's longer in commercial, but I don't want to get into the weeds of this, but just know it's a paper loss that an arbitrary, who knows how they came up with 27 and a half years. Someone sat around the table one day and probably came up with that, but that's what it is. And so we get to write off the depreciation over that amount of time while we own the real estate. Now, that's not a huge benefit, 27 and a half years. It's a long time. It's not really benefiting anybody. But what's significant is what the tax code allows us to do, and even the new things that have been implemented in Trump's campaign or Trump's time in office. And the two things I want to talk about today is, one, cost segregation, and two, bonus depreciation, how they work together to really benefit you as a real estate investor. So we've already said that you have the depreciation loss over 27 and a half years. Well, cost segregation is pretty massive. Let me define it first. And I'm using an article. I'll give him a shout out here. The Real Estate CPA blog, I think it's /cost segregation, written by Thomas Castelli, and he does a great job defining cost segregation. He says it's a tax strategy that allows real estate owners to utilize accelerated depreciation deductions to increase cash flow, reduce the federal and state income taxes they pay on their rental income. This is done by breaking down and reclassifying certain interior and exterior components of a building, which are typically depreciated over 39 or 27 and a half years for commercial and residential properties, respectively, to personal property or land improvements that are depreciated over 5, 7, or 15 years. Now, if I lost you, this is simply what this means. We're taking something that would have taken several decades, and we, as from a cost segregation study, can analyze that and take large portions of this real estate that was supposed to take 30 years to depreciate and begin to accelerate that in the first 5, 7, or 15 years. So we speed up that depreciation expense early on. that's really beneficial. But it gets even better because when Trump came into office, he implemented something else called bonus depreciation. So now what bonus depreciation allows us to do, we can use the personal property placed into service. So the law is after 9/27/2017. Use personal property placed into service after this date is eligible for 100% bonus depreciation. That means real estate investors can deduct 100% of the 5, 7, and 15-year property, all the things that the cost segregation study analyzes and says this qualifies, into the first year. So what would have taken 30 years to depreciate, we can now accelerate all of that into the first year, which is now massive. And so really simply, when we buy a commercial real estate building, when we buy a large multifamily apartment complex, and we do a cost segregation study on that, and we're using bonus depreciation, typically it's I see this all the time, typically 50 to 97% of what you invest into that project, you actually see as a net tax loss on your K1 statement. When you get your, again, a K1 statement is something you get as a passive investor, but even if maybe you own the real estate outright, you'll see that because of this, even though maybe you have revenue coming in from the profit, tenants are paying you, and you've made, let's say, $6,000 from your passive investment, or you've made $100,000 because you own the property. Typically what we're seeing is that actually when you get that in paper and you show your CPA, it looks as if you lost money. Why? Because we have all of this depreciation that we're accelerating into year one to offset the income that you've made from the property. And this is why this is so sweet, because if you're a real estate professional, meaning more than 50% of your time is spent on real estate activities, you can take that net tax loss that you're now showing and apply that against ordinary income. So, again, if you pay taxes on what you make that year, now you have, let's say, that $100,000 as a net tax loss that you can use against other ordinary income. This is massive. This is why Donald Trump's one of the reasons why he's not paying federal income taxes, because he has a huge net tax loss because of all the real estate that he owns. Now, if you're not a real estate professional, you're just an investor and you have another job, now you don't necessarily get that massive benefit of being able to write it against your ordinary income, but you do get to use the depreciation expense that we get from the cost segregation study and the bonus depreciation against your passive income. And so this is still huge, because if you're paying taxes on other passive investments, so you own a rental property or you have income from your stock portfolio or whatever it is, other passive income, you can use that tax loss against that, which again lowers your tax liability. So it's a massive way to continue to keep more money into your pocket. There are also other ways to qualify as a real estate professional. Now, you have to be doing real estate activity. There's not like this huge loophole where you can't be a real estate professional and qualify as that. But is your spouse a real estate agent? Does he or she own, a real estate business? There are ways that you can qualify as a real estate professional and legit, like you're a legit real estate professional and take advantage of this. So you might consider that. But again, you don't have to be in order to take advantage of this incredible vehicle, and this incredible tool that we have with cost segregation and bonus depreciation. So that's what I want to talk about today, and just help you realize the vehicle, the tax-saving vehicle. We talk about tax savings in real estate a lot, but don't really understand what it is and how it's written and who it's benefiting. And so again, you don't have to be Donald Trump. You don't have to be this billionaire to start investing in real estate and using the depreciation expense in order to keep more money in your pocket next year. And so, listen, I hope that's helpful. you can, if you want to get the rest of this video series and get access to the other things that we're going to be talking about in this series, like the predictable wealth building strategy, the wealth multiplier, then click the link in the show notes below and grab, make sure you enter your email, and you'll be getting all of these straight to your inbox right away. Listen, I hope this is helpful. Go to ellishammond.com if you want to learn more about investing in real estate as well. It's another great place for resources and education. We'll see you next week. Cheers.